After more than 2 years of disruption due to the COVID-19 outbreak, anyone thinking that the U.S. economy will finally resume normal operations in 2022 has been sorely disappointed. A conflict in Ukraine, rising inflation, and higher interest rates are stoking fears that the United States is on the verge of a recession. Several reputable economic indicators are flashing warning signs that the U.S. economy may be in trouble. Fortunately, the job market in the United States remains strong, and analysts are divided on whether a recession is imminent in this unusual economic climate. This is why Fed Chair Jerome Powell stated this summer that the United States was not going through a recession. Although the probability of a recession is increasing, analysts warn that the typical American should not worry. Recessions have been quite regularly creating appealing possibilities for long-term investors. The global economy is hanging on the brink, and markets all around the world are flashing warning signs. The question of a recession is no more whether one will occur, but when. The pulse of those flashing red lights has accelerated over the last week as markets wrestled with the fact, once hypothetical, now obvious, that the Federal Reserve will continue its most aggressive monetary tightening campaign in decades to extract inflation from the U.S. economy, even if it means causing a recession, even if it comes at the price of consumers and companies well beyond the borders of the United States. According to research company Ned Davis, there is now a 98% risk of a worldwide recession, which adds some depressing historical reality to the discussion. Only twice before has the firm's recession likelihood estimate been as high, in 2008 and 2020. Supply chain problems in Asia, as well as economic penalties on Russian oil and gas, have worsened the United States inflation problem, which began in 2021. The Federal Reserve likewise misjudged how forcefully it should have to intervene to contain inflation. According to the BEA, the Personal Consumption Expenditures, or PCE, price index increased 6.3% year-on-year in July. The Fed's preferred gauge of U.S. inflation, Core PCE, was up 4.6% year-on-year. While Core PCE growth has slowed slightly from its peak of 5.3% in February, it is still close to multi-decade highs last seen in the 1980s. The burden of rising prices for basic goods and services is falling mostly on consumers. The Bureau of Labor Statistics stated on September 13th that the Consumer Price Index, or CPI, a measure of the cost of living, increased by 8.3% over the previous year, despite the fact that gas prices began to fall. In response to rising inflation, the Fed has hiked the federal funds rate significantly this year, including 75 basis point rises in June, July, and September. With inflation persistently high, the Fed has to undertake yet another hawkish turn by raising rates another 75 basis points and communicating to markets that more rate hikes are warranted to drive down inflation, said Charlie Ripley, senior investment strategist at Allianz Investment Management. According to CME Group's Fed Watch tool, the bond market is presently pricing in a 65% likelihood of a 50 basis point rate rise and a 34% possibility of a 75 basis point rate hike in November. There is a 1% probability of gaining a whole percentage point. The more interest rates increase, the more expensive it is for American businesses to borrow money to invest in innovation and development. Rising credit card, mortgage, auto loan, and other interest rates lower Americans' disposable income, impacting company earnings and stock prices. Of course, that is the point the Fed wants to keep inflation at bay by slowing the economy. They're hoping to accomplish it without inflicting too much harm. When the yield on the 2-year Treasury note surged above the rate on the 10-year Treasury notes in early July, a phenomenon known as a yield curve inversion, worries about a U.S. recession increased. Historically, an economic recession has been strongly predicted by inverted yield curves. The U.S. economy has usually entered a recession within 18 months of a yield curve inversion 2/3 of the time. The present yield curve inversion is the most pronounced since 2007, the year preceding the infamous global financial catastrophe. Despite historically high inflation, the business has been expanding across industries over most of the epidemic era. That is due once again to the persistence of American consumers, since firms were able to pass on their greater expenses to consumers in order to cushion profit margins. However, the profits boom may not persist. In mid-September, one firm, whose fortunes serve as a type of economic barometer, surprised investors. FedEx, which operates in over 200 countries, suddenly reduced its projection, warning that demand was weakening and earnings were projected to fall by more than 40%. In an interview, the company's CEO was asked if the downturn foreshadowed a worldwide recession. "I believe so," he said. "These figures don't seem promising." After Bloomberg reported that Apple was abandoning plans to raise iPhone 14 manufacturing because demand was less than anticipated on Tuesday, the company's stock price dropped. And just before the holiday season, when firms would ordinarily drive up recruiting, the atmosphere has shifted to one of caution. "We haven't seen the typical September bump in employers posting for temporary staff," said Julia Pollack, ZipRecruiter's senior economist. "Companies are waiting to see what the situation will be." In case anybody needs yet another awful historical comparison, equities are now on course for their worst year since 2008, and Wall Street has been dealt a whiplash. Last year, though, was a completely different story. The S&P rose 27% in 2021 due to a flood of cash pushed in by the Federal Reserve, which began a double-barreled monetary easing strategy in the spring of 2020 to protect financial markets from collapsing. The celebration lasted until early 2022. However, when inflation set in, the Fed began to remove the figurative punch bowl, raising interest rates and dismantling the market-stimulating bond-buying mechanism. The hangover has been excruciating. The S&P 500, the broadest indicator of Wall Street and the index that accounts for the majority of Americans' 401ks, is down roughly 24% for the year. And it's not the only one. All three main U.S. indices are in bear markets, having fallen at least 20% from their all-time highs. In an unexpected twist, bond markets, which are generally a safe refuge for investors when stocks and other assets collapse, are now in a spiral. Bond prices have fallen as a result of inflation and the central bank's sharp increase in interest rates, which has also increased bond yields, also known as the return investors receive for lending money to the government. The 10-year U.S. Treasury yield momentarily reached 4% on Wednesday, reaching its highest level in 14 years. That increase was followed by a precipitous collapse in reaction to the Bank of England's intervention in its own spiraling bond market. Seismic shifts in a financial world supposed to be stable, if not plain dull. The rise in interest rates by central banks in Europe to support their own currencies is also pushing up yields on European bonds. There are few safe havens for investors' money right now, and that's unlikely to change until global inflation is brought under control and central banks remove their hold.